Hi there. In this topic video, we're focusing on the balance of payments and in particular the causes of and the significance of a current account deficit. Here are the figures for the UK. You can see if you follow the blue line that our trade balance in goods and services is in deficit and it averages around 2% of our GDP most years. But the current account balance, which is in red, that includes, of course, the net balance in primary income and secondary income. Well, that's significantly bigger. Indeed, in 2015, Britain's current account deficit was nearly £100 billion, equivalent to just over 5% of our GDP. And that was the largest annual current account deficit as a share of GDP measured at current market prices since 1948. So Britain is running an enormous current account deficit, by some measures the second biggest in dollar terms in the world. However, there are some countries that are experiencing even bigger current account shortfalls when expressed as a percentage of their national income. Look at this table drawing the data from the IMF. These are countries that are heavily in external deficit. Libya in 2015 had the biggest current account deficit. Of course, only a couple of years back it was running a current account surplus, but the collapse in its economy, particularly the value of its oil exports, has been disastrous. Now, many of these countries are particularly poor. Many of them are susceptible to big swings in world prices. But there are some nations here that are running current account deficits that are simply unsustainable. So in this topic video, I just want to think about what's causing a current account deficit. It's important to make a distinction in your A-level macroeconomics between supply side or structural causes and demand side or cyclical causes of a current account deficit. So let's quickly look at some structural causes. Oftentimes, countries running current account deficits year on year are suffering from a lack of competitiveness, either in price or non-price factors. And these factors mentioned on the left-hand side here really try to capture that. Deficit countries tend to underinvest and have relatively low productivity or high unit labour costs. So underinvestment is a supply-side cause. A relatively low level of labour and capital productivity can make your businesses less competitive. And so too can a country which has persistently high relative inflation. So, for example, if your inflation is 8% and the average of your main trading partners is, let's say, 2%, then assuming the exchange rate stays the same, you'll be losing 6% of price competitiveness every year. Another cause on the supply side is a low level of research and development, or not enough companies, not enough businesses on the cutting edge of the technological frontier. And it can often be the case in the long run that current account deficit is the result of the emergence of lower unit labour cost competition. So we may see a shift of manufacturing to those nations and a loss in export market share for the higher cost countries. So these are structural causes. However, there can also be some cyclical causes of a deficit. Now, cyclical tend to be short-term factors in tune with changes in the economic or the business cycle. So, for example, it could be the case that the deficit is partly the result of a strong, perhaps overvalued exchange rate. Keep in mind that a high currency increases the price of exports in overseas markets, and an appreciating currency also makes imports cheaper, causing domestic consumers to switch their spending towards cheaper imported products. There could have been a boom in domestic demand, consumers spending more money and sucking in imports as a result. Or perhaps there's been a recession in one or more major trade partner countries. So that would cut the total value of your exports to those nations. Another cyclical cause could be that you're dependent on one particular commodity, for example oil or gas, coffee or copper, and the world price of that commodity slumps, causing you to see a significant fall in your valuable exports. Primary commodity exporters are particularly vulnerable to changes in world price. Another cyclical cause could be that your country is growing quickly and needs to import technology, raw materials and components. So sometimes a current account deficit is actually the result of or the consequence of a fast-growing country that's having to import significant amount of capital. So hopefully this gives you a feel for the difference between longer-term supply-side structural factors affecting a current account deficit and slightly more short-term demand-side explanations, which we basically call cyclical. Why is a current account deficit significant? Firstly, it's a net outflow of aggregate demand from a nation's circular flow because imports M is greater than X. And this is a drag on a nation's GDP growth. A fall in exports could also lead to a significant and important loss of jobs, not just in the export industries themselves, but the industries that supply the trade sectors, logistics, transport, finance, etc. So there could be a negative multiplier effect from a slump in exports. Thirdly, if you're running a current account deficit, then it may be the case, particularly for the countries we saw a few minutes ago, that they very quickly run short of essential foreign exchange reserves. Their stock of dollars dwindles pretty quickly. Now that can be particularly problematic for very small developing nations who struggle to attract the necessary financial capital to balance their books. A current account deficit also leads to exchange rate weakness. We'll cover the link between exchange rates and the balance of payments in a separate topic video. But if the exchange rate depreciates on the back of a current account deficit, that is going to increase the cost of, for example, imported food and imported energy. It's going to lead to an increase in inflation, which will hit people's living standards. And it also means, if the currency is weak, it also means that the investor risk of investing in a nation goes up. The government, for example, might have to offer a higher interest rate on any loans that it takes out. The big question in Year 2 macroeconomics for countries running a current account deficit is whether they are sufficiently well placed to be able to attract the necessary financial inflows, portfolio investment, hot money, foreign direct investment, to be able to cover their current account deficit. That's the big question. Countries which are running a current account deficit, which can't attract the necessary capital to balance their books, can run into a balance of payments crisis. So this has been a topic video looking at the causes of and the significance of a current account deficit on the balance of payments.